Hi, today we're going to look at the use of return of capital in a Canadian-controlled private corporation's investment account. Return of capital is a tool which is designed and intended to return the already taxed capital to the owner of the account on a monthly basis and defer any growth and the ultimate tax bill on this growth until liquidation. When this growth will eventually be withdrawn, it will be taxed as a capital gain. Now the problem is with a Canadian-controlled private corporation is the owner of the account is the Canadian-controlled private corporation. So the return of capital is paid into the corporate bank account. If this money is then withdrawn from that corporate bank account and paid out to a shareholder, it will create a current tax bill in the hands of the shareholder depending on how it's paid out. Many advisors make the mistake of using return of capital in a Canadian-controlled private corporation's investment account to create the cash to pay out to the shareholder in the form of a dividend or a salary. This will create a current tax bill in the hands of the shareholder and a deferral inside the corporation. A more efficient way to create this cash flow to pay out to the shareholder would be the use of eligible Canadian dividends. So if we examine the use of either return of capital or eligible Canadian dividends as the source of cash in a corporation to pay out to a shareholder, we will see that the return of capital creates the cash with a tax deferral in the corporation and is then paid out at a relatively high tax rate to the shareholder as a dividend. If we contrast that to eligible Canadian dividends, there is in fact a tax bill in the corporation, but this is 100% refundable when paid out as a dividend to the shareholder, who will ultimately pay a lower tax bill than in the return of capital alternative. Let's look at the proper use of return of capital inside a Canadian-controlled private corporation. 3 examples. First, if a corporation has a life insurance policy that is primarily there for estate purposes, it's a great way to create the cash inside the corporation to pay for the life insurance premiums. Another example would be if a corporation owes money to a shareholder as a shareholder loan, it's a great way to create the cash to repay that loan. And finally, if a corporation has expenses in excess of its normal working capital requirements, it's a great way to create this surplus cash to pay current corporate expenses. So how can NexGen help? Well, if you've decided you need eligible Canadian dividends, our structure has the intention with the Dividend Tax Credit Class of providing you with a flow of eligible Canadian dividends paid directly into the corporate's bank account in order to flow out to the shareholder. If in fact you've decided return of capital is the best process for you in this case, our return of capital class has the intention of paying out 100% return of capital with a 100% deferral of any growth inside the fund in question. Hopefully this helps, and for more information, please consult our website.